The agricultural markets erupted in a frenzy recently as geopolitical tensions collided with record-breaking demand, transforming quiet trading floors into battlegrounds where fortunes shift with every headline from the Black Sea. While diplomats exchanged threats across international waters, traders frantically repositioned billions of dollars in grain contracts, and cattle futures surged to unprecedented heights amid supply constraints that have reshaped the entire meat industry. This isn't just another market fluctuation, it's a full-scale confrontation between global political forces and the fundamental economics of food security, with American farmers, consumers, and traders caught squarely in the crossfire. The Black Sea powder keg, when politics became price action. The catalyst for the recent grain market explosion came from an escalating situation in the Black Sea region that sent shockwaves through global wheat markets. Tensions intensified when the Biden administration authorized Ukraine to deploy American-supplied long-range missiles within Russian territory, prompting aggressive responses from Moscow that immediately translated into market volatility. Wheat futures led the charge higher, as market participants scrambled to add risk premiums as the conflict threatened one of the world's most critical agricultural corridors. The Black Sea region represents a cornerstone of global wheat supply, with exports from Russia and Ukraine accounting for a substantial portion of international trade. When geopolitical friction disrupts this flow, the reverberations are felt worldwide. Russia's unfriendly response to Ukraine's expanded military capabilities reignited concerns about the conflict's impact on grain exports, driving traders to seek protection through futures positions. This wasn't merely speculative positioning. It reflected genuine anxiety about supply disruption in a region that feeds millions across the Middle East, North Africa, and beyond. The situation intensified further when Russia declared the Black Sea grain deal was no longer viable, followed by threats to sever Ukraine's sea access after drone attacks on Russian vessels. These developments eliminated any remaining sense of security among market participants. Wheat prices responded immediately, with futures contracts pushing higher as traders recognized the potential for sustained disruption. The market's reaction wasn't simply about current supplies. It reflected a fundamental reassessment of global grain trade architecture in an era of persistent geopolitical instability. What makes this situation particularly explosive is the compounding effect of multiple stress factors. Beyond the immediate conflict, drought conditions emerged in key wheat-growing regions, with Russia's Voronezh region declaring a state of emergency. This convergence of political risk and weather challenges created a perfect storm for price appreciation. Wheat export prices in Russia rose even as shipment volumes increased, suggesting tightening fundamentals beneath the geopolitical noise. Corn catches the wave, the spillover effect. While wheat grabbed headlines, corn quietly positioned itself as a secondary beneficiary of the market turmoil. Corn futures initially hesitated, constrained by technical resistance levels and harvest pressure, but the momentum from wheat eventually pulled corn higher. This spillover effect demonstrates the interconnectedness of modern grain markets, where risk premiums don't respect commodity boundaries. The corn market found itself in a peculiar position, fundamentally strong but technically challenged. Export inspections were running 71% ahead of year-ago levels, reflecting robust international demand. Yet this record-setting export pace had already been incorporated into prices, leaving the market hungry for fresh, bullish catalysts. The geopolitical tensions provided exactly that catalyst, giving corn the momentum needed to challenge key resistance levels. Beneath the surface, corn fundamentals remained remarkably constructive. Strong ethanol production numbers combined with exceptional export activity suggested demand was outpacing earlier projections. Market participants increasingly discussed the possibility of lower-than-expected yields, with some analysts projecting national averages in the 179 to 180 bushel range, potentially tightening ending stocks significantly. This fundamental backdrop meant that once geopolitical concerns provided the initial spark, corn had sufficient underlying support to sustain gains. The technical picture for corn revealed the importance of breaking through psychological barriers. December corn pushing back above the $4.25 level represented more than just a numerical milestone. It signaled a shift in market psychology. Fund traders who had been cautiously positioned began to recognize that the combination of strong demand, potential yield concerns, and geopolitical risk premiums created an environment conducive to price appreciation. The China factor, a wild card in grain markets. No discussion of current grain market dynamics is complete without examining China's role, particularly in the soybean complex. While wheat and corn responded primarily to geopolitical developments, soybeans navigated their own complex relationship with the world's largest buyer. The announcement of potential Chinese purchases created immediate volatility, with market participants parsing every detail of proposed trade frameworks. Treasury officials announced China agreed to purchase 12 million metric tons of American soybeans for 2025, with 25 million metric tons annually for 3 subsequent years. This development, while significant, presented a mixed picture. The volumes represented improvement over the complete absence of Chinese buying during trade tensions, but fell short of historical peak purchase levels. Market reaction reflected this ambivalence, initial euphoria giving way to more measured assessment. The China situation introduces persistent uncertainty into grain markets. Despite announced commitments, questions linger about enforceability and whether commercial considerations might allow China to circumvent purchase obligations. Previous trade agreements demonstrated that headline commitments don't always translate into actual flows. This skepticism keeps soybean markets on edge, creating volatility as traders attempt to gauge the probability of promises becoming performance. Meanwhile, China's complicated relationship with global grain suppliers continues to evolve. The rejection of a 69,000 metric ton vessel of Brazilian soybeans due to contamination, along with bans on multiple Brazilian exporters, potentially opens opportunities for American product. These developments highlight the fragility of agricultural trade relationships and how quality issues can suddenly reshape market dynamics.
Cattle markets, the perfect storm of supply constraint. While grains captured attention through geopolitical drama, cattle markets created their own spectacular narrative through fundamental supply-demand imbalances. Cattle futures soared to record levels, driven by the tightest supply situation in generations, combined with remarkably resilient consumer demand. This represents perhaps the most sustained bullish environment in cattle market history. The foundation of the cattle rally rests on stark supply realities. The cattle inventory report confirmed the smallest cattle herd in 65 years, with total inventory at only 86.7 million head. This isn't a temporary phenomenon. It's the culmination of years of drought, high input costs, and industry consolidation that decimated herd sizes. Slaughter levels continued declining, with projections showing another million head reduction in annual harvest volumes. What makes the cattle situation particularly remarkable is the persistence of demand despite record-high prices. Ground beef reached approximately $6.25 per pound in July 2025, the highest level since records began in 1984. Yet consumers continue purchasing beef at rates that support further price appreciation. This demand resilience fundamentally alters market dynamics, removing the traditional price ceiling that typically caps rallies. The cattle market's strength creates ripple effects throughout the agricultural economy. Feeder cattle prices reached levels that challenge the economics of feeding operations, even as finished cattle values hit new highs. This compression of margins forces feedlots to carefully manage placement timing and sourcing strategies. The closure of Mexican cattle imports due to screwworm concerns eliminated a critical supply source, further tightening already constrained markets. Technical factors amplified the cattle rally, with futures occasionally hitting limit moves as fund traders scrambled to establish positions. These dramatic price swings reflect the intensity of supply tightness. deferred contracts trade at substantial discounts to nearby positions, suggesting markets expect eventual herd rebuilding, but that process remains distant, keeping near-term supplies extraordinarily tight. Technical analysis, reading the chart battle. Technical factors played crucial roles in the recent grain and livestock rallies, with key resistance levels and moving averages acting as critical decision points for fund traders. Understanding these technical dynamics helps explain the intensity and timing of price movements. Wheat futures found themselves in deeply oversold territory before the geopolitical catalyst emerged. All three wheat classes had tested multi-year lows, creating a technical setup primed for explosive moves higher. Fund short positions had reached near record levels, meaning any sustained buying would trigger short covering that amplifies price gains. When geopolitical concerns provided the fundamental justification, technical factors magnified the response. Corn's technical situation presented a different challenge. The market struggled repeatedly to break above its 200-day moving average, creating a resistance zone that capped earlier rally attempts. This technical barrier became self-fulfilling as traders established short positions against that level. Once geopolitical concerns provided sufficient momentum to clear this resistance, short covering accelerated the move. The ability to close above the 20-day moving average signaled a potential shift in trend direction that attracted additional fund buying. Soybeans navigated their own technical landscape, with key resistance at the $11 level in March contracts representing a critical psychological barrier. This level marked previous highs from earlier in the year, making it a natural profit-taking zone. The China news pushed prices toward this resistance, but sustained breaks above such levels require follow-through buying that hasn't consistently materialized. This creates a pattern of advances followed by consolidation or modest retreats. Cattle futures demonstrated the power of momentum in thin markets. Limit moves in feeder cattle contracts illustrated how quickly prices can accelerate when supply tightness meets technical short covering. The 200-day moving average provided support levels that held during pullbacks, establishing a floor that gave buyers confidence to establish or add to long positions. This technical underpinning, combined with fundamental supply constraints, created an environment where every dip attracted buying interest. The weather wildcard: drought concerns mount. Weather patterns emerged as an increasingly significant factor affecting grain markets, particularly in wheat-producing regions. Drought conditions that triggered emergency declarations created genuine production concerns that reinforce geopolitical risk premiums. This weather threat adds another layer of uncertainty to an already volatile situation. The persistence of dry conditions in major wheat belts heightens concern for crop establishment and winter survival. While recent rainfall in some hard red winter wheat areas of the southern plains provided temporary relief, broader concerns about moisture profiles remain. Weather markets can be particularly volatile because forecasts change rapidly and production impacts remain uncertain until crops progress through critical growth stages. Weather concerns extend beyond immediate growing regions. Global production patterns show how localized weather events can have international implications. Reduced wheat production forecasts from the European Union, Russia, India, and Brazil collectively tightened global supplies, even as Ukrainian production provided some offset. This geographic dispersion of weather challenges makes it difficult for markets to find comfortable equilibrium. The intersection of weather concerns with geopolitical tensions creates compounding uncertainty. Markets must simultaneously assess political disruption risks and agricultural production challenges, making it extraordinarily difficult to establish confident price projections. This dual-layer uncertainty keeps volatility elevated and option premiums expensive, reflecting genuine uncertainty about future price paths.
Fund positioning, The role of fund traders and managed money in recent market movements cannot be overstated. These participants, who trade based on technical signals and momentum rather than fundamental supply-demand analysis, amplify price movements in both directions. Their positioning and behavior often determine whether fundamental developments translate into sustained price trends or merely temporary spikes. Fund short positions in wheat reached near-record levels before the recent rally, creating a classic setup for explosive short covering. When prices began rising on geopolitical concerns, short holders faced mounting losses that forced liquidation of positions. This covering became self-reinforcing. As prices rose, more shorts faced pressure to exit, pushing prices even higher and triggering additional covering. This dynamic explains why wheat led the grain complex higher with such intensity. In corn, fund positioning was more neutral, allowing for two-sided trading as the market processed new information. This balanced positioning meant price movements reflected fundamental developments more directly, rather than being amplified by position squeezes. However, as corn broke through key technical levels, momentum traders began establishing long positions, providing fuel for further gains. Cattle markets presented a unique fund positioning situation. The intensity of the supply shortage created a one-way trade that attracted significant managed money interest. Funds accumulated large long positions, betting on continued tightness. While this positioning creates vulnerability to sharp corrections if fundamental conditions change, the persistence of tight supplies has rewarded this strategy. The challenge comes when attempting to exit these large positions in markets with limited liquidity. Export dynamics. Following the money. Understanding actual and potential export flows provides critical insight into grain market direction. Export demand represents the marginal buyer that often determines price levels, making trade developments particularly market-moving. Corn export performance stands out as exceptionally strong. Record-setting inspection volumes running 71% ahead of a year-ago levels demonstrate genuine international demand. This isn't just paper sales. These are physical shipments moving through ports, confirming that foreign buyers are actively purchasing American grain. Such robust export activity provides fundamental support that gives traders confidence in holding long positions. Wheat export dynamics present a more complex picture. While strong inspection numbers show continued international buying interest, questions about Black Sea supply reliability create uncertainty about future competition. If Russian and Ukrainian wheat face sustained logistical challenges or export restrictions, American wheat becomes more competitive in global markets. This potential shift in trade patterns supports higher price expectations. Soybean export prospects remain heavily dependent on Chinese purchasing decisions. The announced framework for future purchases provides a roadmap, but execution uncertainty keeps markets cautious. Actual shipment data must accelerate significantly to meet even the reduced commitment levels, creating tension between hope and reality in market psychology. The inflation connection, food prices and policy, carries implications far beyond commodity trading pits. Rising agricultural commodity costs inevitably translate into higher food prices, affecting consumer budgets and potentially influencing monetary policy decisions. This connection between commodity markets and broader economic conditions creates feedback loops that can amplify or dampen agricultural price movements. Record cattle prices directly impact retail beef costs, with consumers already facing the highest ground beef prices in history. While demand is proven resilient so far, there are limits to how much price appreciation consumers can absorb before shifting to alternative proteins or reducing consumption. This demand elasticity eventually becomes a governing factor on how high cattle prices can rise. Wheat and corn price increases similarly flow through to bread, cereal, and processed food costs. While commodity costs represent only a portion of final retail prices, sustained increases at the farm level eventually show up on grocery store shelves. For policymakers concerned about inflation, agricultural commodity price rallies represent a challenge. They're largely driven by supply fundamentals that monetary policy cannot directly address. The dollar's value adds another dimension to this relationship. A weaker dollar makes American agricultural products more competitive internationally, supporting export demand and domestic prices. However, a weaker dollar also contributes to imported inflation. This complex relationship means that currency movements can either amplify or offset commodity price trends depending on the specific dynamics at play. Risk management, navigating unprecedented volatility. The current environment of elevated prices and extreme volatility creates both opportunities and dangers for agricultural producers and commercial users. Effective risk management becomes crucial when markets swing wildly on geopolitical headlines and fundamental uncertainty persists. For grain farmers, the recent rally presents difficult decisions. Selling forward at elevated prices locks in profits but sacrifices upside potential if conditions deteriorate further. Using option strategies allows capturing minimum price levels while maintaining upside exposure, but option premiums in volatile markets can be expensive. Each producer must balance their individual risk tolerance against operational needs and market outlook. Cattle producers face equally complex decisions. Record calf and feeder cattle prices create tremendous current income but challenge the economics of herd rebuilding. Retaining heifers for breeding comes at the opportunity cost of immediate sales at historic prices. Some producers adopt blended approaches, selling portions while retaining select genetics for future production. Commercial grain users, ethanol plants, flour mills, feed manufacturers must manage price risk on the buy side. When futures markets rally sharply, basis often weakens as local cash prices lag futures gains. This creates opportunities for commercial buyers to establish coverage through basis contracts while deferring futures price setting. However, betting on falling futures when geopolitical tensions persist carries its own risks.
Looking ahead, what's next for agricultural markets? Projecting future price direction in the current environment requires assessing multiple interconnected factors, each with significant uncertainty. Geopolitical developments, weather patterns, fund positioning, and demand trends all influence outcomes, and none are easily predicted. The Black Sea situation remains the wild card for grain markets. Any movement toward conflict resolution could quickly deflate risk premiums, pressuring prices lower. Conversely, escalation or sustained disruption to Ukrainian exports would support continued price strength. The binary nature of these outcomes creates an environment where headlines can drive dramatic price swings. Cattle markets face their own uncertainty regarding supply trends. The current tight situation reflects years of industry contraction that won't reverse quickly. Even if producers aggressively retain heifers for breeding, meaningful herd expansion remains years away. This suggests continued supply tightness and price strength, though volatility will likely persist as markets navigate between bullish fundamentals and concerns about demand destruction at elevated prices. Weather developments through winter months will significantly influence wheat markets. Adequate moisture in domestic growing regions and successful crop establishment could ease supply concerns, while continued drought would reinforce bullish sentiment. Spring planting intentions for corn and soybeans will provide insight into producer response to current prices and expectations about future demand. Chinese purchasing patterns deserve continued close monitoring. If actual shipments begin confirming announced purchase commitments, soybean markets could find sustained support. Alternatively, if Chinese buying fails to materialize, markets will likely retreat from current levels. This makes every export sales report and shipping data release potentially market-moving. The bigger picture: food security in a fractured world. Beyond immediate price movements, the current situation highlights broader concerns about global food security in an increasingly fragmented geopolitical environment. When political tensions can rapidly disrupt grain flows from major exporting regions, food importing nations face genuine vulnerability that transcends market economics. The concentration of wheat exports in the Black Sea region creates systemic risk that recent events have brought into sharp focus. Middle Eastern and North African nations dependent on these supplies face difficult choices when conflict threatens availability. This vulnerability drives efforts toward agricultural diversification and food sovereignty, potentially reshaping long-term trade patterns. Climate change adds another layer of complexity to food security discussions. More frequent and severe weather events disrupt production patterns, creating volatility that markets struggle to price efficiently. The intersection of climate challenges with geopolitical tensions multiplies risks and uncertainties for all market participants. Technology and innovation offer potential solutions to some challenges. Improved crop genetics, precision agriculture techniques, and enhanced storage and logistics capabilities can help buffer against supply disruptions. However, these advances require time and investment to implement broadly, meaning near-term vulnerability persists. The current episode serves as a powerful reminder that agricultural commodities aren't merely financial instruments. They represent the foundation of global food supplies. When markets surge on conflict and constraint, real people face real consequences in the form of higher food costs and potential shortages. This human dimension should inform policy responses and risk management approaches as markets navigate uncertain terrain. Conclusion: brace for continued turbulence. The convergence of geopolitical tensions, weather concerns, supply constraints, and technical factors has created an explosive environment across grain and livestock markets. Wheat's geopolitical premium, corn's strong export demand, China's uncertain commitments, and cattle's historic supply tightness combine to generate volatility that shows no signs of abating. For market participants, this environment demands vigilance and disciplined risk management. Prices can swing dramatically on headlines, technical levels, and weather forecasts, creating opportunities for nimble traders, but dangers for those caught on the wrong side of sudden moves. The interconnected nature of modern agricultural markets means developments in one sector quickly influence others, requiring broad awareness beyond individual commodities. The fundamental drivers supporting recent price strength, genuine supply concerns, robust demand, and geopolitical uncertainty appear likely to persist. This doesn't guarantee continued price appreciation, but it suggests volatility will remain elevated as markets process each new data point and headline. The question isn't whether agricultural markets will experience turbulence, but rather how severe that turbulence will be and who will successfully navigate it. As this agricultural drama unfolds, one certainty emerges. The intersection of politics, weather, and economics in food markets creates a compelling narrative that extends far beyond trading screens. The decisions made in Moscow, Beijing, Washington, and farming communities worldwide will shape not just commodity prices, but food security and economic stability for billions of people. In this high-stakes environment, understanding the forces driving prices higher becomes essential for anyone connected to agricultural markets or concerned about the global food system's resilience.